All right, something massive just happened in the precious metals market, and most people don't understand what they're looking at yet. Silver didn't just dip, it didn't correct, it collapsed. We're talking about a drop from roughly $121 an ounce down to about 85 in a matter of days. That's a 37% wipeout. Billions evaporated. And here's the part that just broke. While Western investors were panic selling, reports confirmed China stepped in and started buying billions in gold and silver. Both Western pricing feeds and Shanghai market data are confirming the split right now. Stay with me, because I'm going to show you why this matters, how this actually works, and how you can spot this pattern before the crowd next time. If you're holding silver, if you're watching metals, if you've got capital on the sidelines, your job right now is to understand what's really happening beneath the surface. Before I explain what caused this, let me teach you something most people never get told about metals markets. When you hear someone say silver price, you probably assume there's one price. There isn't. There's the paper price, traded mostly in Western futures markets, and there's the physical price, which shows up where actual metal changes hands. Think of it like this: airline tickets versus actual planes. Tickets can be dumped instantly. You can sell 10,000 tickets in seconds. Planes can't move that fast. They're physical. They take time. They require storage, shipping, verification. So when leverage builds up in paper markets, prices can crash even if physical demand never disappears. That difference is everything. And if you don't understand that distinction, you'll always feel like these moves come out of nowhere, even though they don't. The pattern's been there the whole time. Here's what that looks like in practice. In futures markets, most participants aren't taking delivery. They're not building warehouses. They're trading exposure. It's leverage on leverage. And that's fine when markets are calm. But when volatility spikes, that leverage becomes a liability. So you get these violent dislocations where paper markets move one direction and physical markets barely budge. It's not manipulation, it's just structure. Different players, different time horizons, different constraints. The paper traders are managing margin. The physical buyers are managing supply chains. Those are two completely different games. And when you see a 37% drop in days, you're watching one game break while the other one holds. That's the setup. That's what you need to recognize. Now here's what's actually happening, step by step. Silver had been bid up aggressively over the past several months, partly on inflation hedging, partly on momentum, and heavily on leverage. A lot of that buying wasn't people stacking bars in vaults. It wasn't jewelry manufacturers securing supply. It was paper exposure, futures contracts, options, ETFs with derivative structures underneath. So when volatility spiked and prices started slipping, margin calls kicked in. Funds had to sell. Not because they wanted to, not because their thesis changed, but because they had to meet margin requirements. That forced selling pushed prices lower, which triggered more margin calls, which triggered more selling. That's the cascade. It's mechanical, not emotional. It's not fear. It's math. And here's what's wild about this particular move. While Western spot prices were collapsing toward 85, Shanghai silver barely flinched. It stayed near 122. That's a 40% premium. Let that sink in for a second. If demand had actually collapsed, that premium wouldn't exist. It would have vanished instantly. Arbitrage would have crushed it. Instead, it widened. What does that tell you? It tells you the fundamentals didn't break. It tells you physical buyers still want metal. It tells you the crash was structural, not demand-driven. And that's a completely different animal. When demand collapses, premiums evaporate. When leverage collapses, premiums explode. That's the signal you're looking for. That's how you separate real breakdowns from technical liquidations. Now let me layer in the second piece because this gets even more interesting. While Western markets were in full liquidation mode, reports started surfacing that China was stepping in. Not just watching, not just waiting, actively buying. Billions in gold, billions in silver, converting paper weakness into physical strength. And here's why that matters. China's been doing this for years. They don't trade the same way Western funds trade. They're not managing quarterly performance. They're building strategic reserves. They're thinking in decades. So when paper markets break and create artificial discounts, they see opportunity. They buy real metal at prices created by forced selling elsewhere. It's patient, it's calculated, and it's happened before. But here's the part that should make you nervous if you're only watching Western charts. Once that forced selling exhausts itself, there's no reason for prices to stay disconnected forever. You've got two possible outcomes. Either physical demand breaks and Shanghai prices collapse to meet Western levels, or paper prices snap back to meet physical reality. History tells us which one usually happens. Physical doesn't chase paper down. Paper chases physical up. Why? Because physical supply is finite. You can't print silver bars the way you can print contracts. And when the selling pressure from margin calls finally stops, whoever sold at 85 is going to be looking at a market that's still pricing metal at 122 in the world's largest physical hub. That's a painful realization. Now let me show you something, because this isn't the first time we've seen this exact pattern. Zoom out for a second. This is the exact same playbook we saw in 2008. During the financial crisis, silver collapsed as funds deleveraged. It went from nearly $21 down to under $9 in a matter of months. Brutal. Everyone thought the world was ending. But here's what happened next. Industrial demand stayed intact. Sovereign buyers kept accumulating, and once the forced selling exhausted itself, silver didn't just recover, it exploded. It went from $9 to nearly $50 in less than 3 years. Same structure. Paper broke first, strong hands accumulated quietly. Volatility stayed high for a while. Then price mean reverted hard. Let's look at another one. 2020. Remember March 2020? Liquidity panic. Everything sold off. Silver cratered from $18 down to $12 in 2 weeks. Everyone was convinced metals were done. Industrial demand was going to collapse because of lockdowns. But what actually happened? Physical premiums spiked immediately. Dealers couldn't get metal. Mints were sold out. And within months, silver more than doubled. It went from $12 to over $28. Same pattern. Different crisis. Paper markets panicked. Physical markets held. Strong hands accumulated. Then the snapback came. And if you were only watching the paper price, you missed the entire setup. Here's one more. Go back to 2013. Silver had been in a bull run for years, then it crashed. Went from $32 down to under $19. Massive sell-off, margin liquidations, bearish headlines everywhere. But during that crash, what was happening in physical markets? Mints reported record sales. Sovereign buyers increased purchases. Premiums on physical coins and bars went through the roof. The setup was identical. And what happened over the next few years? Volatility stayed elevated, but the lows held. And when the next cycle turned, silver ran hard again. Every time this structure appears, you see the same rhythm. Paper breaks first. Strong hands accumulate during the chaos. Volatility stays high because traders are still nervous. Then price mean reverts once the mechanical selling stops. When you look at the pattern across multiple cycles, the crash itself isn't the signal. The response is, watch who's buying when everyone else is selling. Watch where premiums go. Watch physical markets versus paper markets. That's where the information lives. Now let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this stay messy longer? Absolutely. Could 85 fail and turn into 75 or even lower? It could. Markets don't owe anyone a bounce, and not every east-west premium resolves cleanly. Sometimes demand really does roll over. Sometimes what looks like a technical sell-off turns into a fundamental shift. You have to respect that possibility. The other thing I want to address is the narrative around China. Yes, reports suggest they're buying. But let me be honest with you, you're not getting real-time verified data on China's central bank purchases. You're getting reports, statements, market signals. Could some of it be noise? Could some of it be positioning? Maybe. The mistake people make is turning this into a conspiracy story or a guaranteed trade. You don't need manipulation theories here. You don't need to believe in some grand plan. You just need to watch the data. Focus on what you can verify. Focus on structure, not narratives. If Shanghai premiums hold, that's verifiable. If forced selling exhausts and volatility compresses, that's observable. If paper and physical converge, you'll see it. Don't get caught up in stories. Watch the mechanics. There are probably 3 types of people watching this right now. Let me speak to each of you directly. The first type is already long and stressed. Maybe you bought silver at 110. Maybe you've been holding physical for years, and you're watching your portfolio value swing wildly. If that's you, here's what I want you to understand. Your job right now isn't to predict the exact bottom. It's to manage risk. If this volatility is keeping you up at night, you're probably overexposed. That's not a judgment, that's just reality. If you can't survive another leg down, you need to think about position sizing. On the other hand, if you're holding physical metal with no leverage and you're thinking in years, not weeks, then this is just noise. Physical silver isn't going to zero. The question is whether you can handle the volatility without making emotional decisions. Be honest with yourself about that. The second type is on the sidelines. Confused. Wondering if you missed something. Maybe you've been thinking about getting into metals for months. Maybe you sold earlier and you're watching this unfold, wondering if you should jump back in. If that's you, here's the truth. You didn't miss anything. Your edge right now is patience. Let the market show its hand. If this is a real bottom, you'll get confirmation. If it's not, you'll avoid catching a falling knife. Don't let FOMO push you into a trade before you have clarity. Watch the levels I'm about to give you. Wait for stability. There's no prize for being first into a collapsing market. There's only a prize for being right. The third type is hunting opportunity. You've got capital. You understand the structure. You're not emotional about metals. You're just looking for asymmetric setups. If that's you, your job is discipline. You wait for confirmation, not excitement. You don't buy because it's down 37%. You buy because the mechanics shifted and risk-reward tilted in your favor. That means watching for forced selling to exhaust. That means watching for premiums to stabilize or widen. That means watching for physical markets to hold while paper markets find support. Different positions, same rule. Don't react emotionally to mechanical moves. And here's the universal principle that applies to all three types. If you're making decisions based on panic or greed, you're already behind. The players who win in these environments are the ones who understand structure, who manage risk, and who wait for their setup. That's it. It's not sexy, but it works. So here's where I stand personally. I'm not chasing this, and I'm not dismissing it. I'm watching it. Let me tell you what I'm personally watching. First, I'm watching whether that 80 to 85 zone actually holds in Western markets. If silver finds support here and volatility starts compressing, that would suggest forced selling is exhausting. If it breaks lower with conviction, that tells you there's more pain coming and you stay patient. Second, I'm watching Shanghai. If physical prices stay above 115, that tells you physical demand is still intact. If Shanghai starts collapsing toward Western levels, that's a different story. That would suggest the premium was temporary and demand is actually weakening. Third, I'm monitoring the premium itself. If it stays above 25%, the recovery scenario stays alive. If it compresses rapidly, that's a warning sign. Those are the three things I'm watching every day, not predictions, not hopes. Just observable data points that tell you what's happening structurally. Based on my analysis, this crash was mechanical, not fundamental. It was driven by margin calls and forced liquidations in leveraged paper markets, not by a collapse in physical demand. The fundamental picture hasn't disappeared. Industrial demand for silver hasn't evaporated. Inflation concerns haven't gone away. Sovereign buying interest hasn't vanished. What changed was leverage. What changed was volatility. And when leverage unwinds in one part of the market while fundamentals hold in another, you get dislocations. Those dislocations don't last forever. Either the fundamentals break or the price adjusts. If history rhymes and physical demand holds firm, the move that follows could be significant. Not a guarantee, not a promise, but a possibility worth watching. Now, I'm not a financial advisor. This is not financial advice. I'm sharing my framework, my analysis, and what I'm watching. You need to do your own research. You need to understand your own risk tolerance. You need to make your own decisions. But if you made it this far, you're thinking critically. You're not just reacting to headlines. You're trying to understand structure and mechanics. That mentality will serve you well, not just in this situation, but in every market you ever encounter. If this analysis helped you see the situation more clearly, do me a favor. Share this video with someone who needs to see it. Subscribe if you want more breakdowns like this, and drop a comment telling me what you think. Are you watching this as a buyer, a holder, or from the sidelines? I want to hear your perspective. Stay sharp out there. Think critically, verify the data, and make your own decisions.